Kevin just posted his 4th video of the day. Man, I gotta catch up. Okay, welcome back, ladies and gents, to another video. Today I wanted to go through, why did I just start screaming like that? Monthly dividend stocks. So the reason why I want to go through monthly dividend stocks is because they are what got me started. And full disclosure, it's more of a psychological thing than, let's say, an outperformance thing. So just because you're compounding your dividends monthly does not necessarily mean that you're going to outperform, but it is a good psychological boost to have some monthly dividend stocks in your portfolio, because while everybody else is panic selling and everybody else is freaking out, you're still getting paid month by month. You're getting paid your dividends, and you understand that an investment is based on, like, the valuation of it is based on how much cash it's going to give you back in the future. So, and it's giving you cash now. So imagine you're getting paid, 10, 20, 30, 40, 50 bucks a month. You don't really care what the price is doing. Obviously, you don't want to just get into a stock that is completely deteriorating as a business, because then you're just bleeding the company dry. So we don't want to do that. We don't want to get into these really high payout ratio companies. But yeah, dividend safety is important. But anyways, let's get into this video. There's only 2 dividend stocks that pay monthly that I would really consider touching. There are plenty of other ones that you can get into. A lot of them are going to be in the business development space. So things like PSEC, in my opinion, garbage stock. I've owned it in the past, but if you look at the dividend tracker for it over time, it's just gone down and down and down. There's certain companies that will basically pay a really high dividend and just bleed their company dry just so that they can attract an investment. Okay, so you don't want to be in that. So today what we're going to be talking about are, number 1, SPHD, and number 2 is Realty Income, ticker symbol O. So something like Realty Income is going to pay you every month. It pays $1.80 in dividends. So we can take that 180 and we divide it up by 12. So it pays on average 15 cents a month. So imagine, let's say that you wanted to make $100 a month. 100 divided by 15 cents. You'd have to buy 666 shares, right? Times, I think it's about $43 right here. So you'd have to put 28K 666 into Realty, or SPHD rather, to get $100 a month. So that's what an investment essentially is. It's something that is going to give you money in the future, or now in the case of a dividend stock. So right off the bat, a couple things that I do and don't like about SPHD is, number 1, the thing that I don't like about SPHD is that it has a somewhat high fee. So it's got a 0.3 expense ratio. So that's a little bit high, right? That can eat into your returns a little bit. But what I do like about it is that it's very stable. It pays every single month, that 15 cents per share. Right now, the share price is about $43.15. So that 666 that we talked about, that's going to be pretty accurate. What I do like about it is the holdings over here. So let's go into the holdings. And as we look at these, we've got things like Altria, we've got ExxonMobil, Kinder Morgan, AT&T, Chevron. We've got basically Philip Morris, PPL. It's companies that are going to benefit from inflation, in my opinion. There's a lot of real estate corporations. There's some companies that basically are business development companies. So they're going to benefit if there's higher interest rates. So we go over to tab 2. We've got IBM, Heinz. We've got Walgreens Boots, Hanes brands. I mean, I don't think people are going to stop buying underwear. We got International Paper. People are going to keep on buying that paper, keep on using Gilead Sciences. We've got Duke Energy, okay, electric utilities. So just basically Southern Company. We've got Verizon. Just basically, we've got a bunch of these companies in here that are very stable, low volatility stocks, 3M in there. And we've got Smucker, Kimberly-Clark. I mean, people are going to continue to buy sandwiches, paper towels, things of that nature. So I really like the holdings in this fund. So one thing that you could do, which is totally valid, is you could go into M1 Finance and create a pie of all of these and avoid the expense ratio. But they do some rebalancing, and that's basically what you're paying for. You're paying for the fund manager. So what I will say that I don't like about this as much, which is kind of what I alluded to at the beginning, is that if you just look at the returns from price appreciation, these companies don't necessarily have the best price appreciation prospects, right? So this has, as far as price appreciation, underperformed the S&P 500. However, our next stock did not underperformed the S&P 500 over the time that it's been listed. So if we look at this Realty Income, they've got some really good clients essentially. So we already just saw Sam's Club, we saw Home Depot. So they've got some really solid businesses that they rent their space out to. So they do commercial real estate. So they've gotten a 15.3 annualized return of total return. So that's dividends reinvested. We've got a 4.4 annual dividend growth since 1944. So you've been growing the dividend pretty quickly over here at Realty Income. Current dividend yield is 4.33%. And like we said, if you put in a certain amount of money, you can know that you're going to get a certain paycheck essentially each and every month. So moving on down here to ex-dividend, this one pays out towards the end of the month. We see 29th, 30th, 31st. So if you want to get a paycheck every single month, it's about 23 cents right now. So if we take our calculator back out, let's say we wanted $100 a month divided by 0.23. We'd have to buy 434 shares. So 65.19 times that amount of shares is 28,343. So if you put in basically 29K, you could get $100 per month. So moving on over here to their tenants. So they've got, like I said, some solid tenants. Here's their top 20 clients, which makes up 52% of their portfolio. Some ones in here that I don't necessarily like are AMC and Regal Cinemas. But the other ones in here, we've got LA Fitness. So gyms, I think gyms are going to open back up and do just fine. We got Walmart / Sam's Club, Walgreens, 7-Eleven, Dollar General, FedEx. These are some people that, regardless of what the economy is doing, as long as the economy is at least slightly open, these people are going to do just fine. And as we see up here, they've got a 97.9% occupancy. From what I remember, they aren't having that bad a time as far as people actually paying their rents. So is the dividend safe? I think it's going to be a really safe dividend. It's going to continue to get paid out. For tax purposes, they do have a higher payout ratio. But anyways, hopefully you guys like this video. You guys take advantage of these two stocks and just take advantage of the opportunity to change your mindset to, I'm not just getting a paycheck from my job, or I'm not just getting a paycheck from my business. I'm getting a paycheck from somebody else's business, okay? From somebody else's labor, if you want to put it in those terms. So got to be a winner out here and make sure that you're collecting those dividends, because you can't work forever, and eventually your money's got to work for you. So hopefully you guys like this video. If you did, make sure you give it a thumbs up, and I'll see you guys in the next video.